Welcome to Beyond the Numbers, the podcast where we take the stress out of business finance and break down the numbers in a way that actually makes sense. Today we're tackling a big frustration for business owners. Why does your bank balance never seem to match your profits? Have you ever looked at your year-end accounts and thought, great, I've made a profit, but then checked your bank and panicked because there's no cash? Well, you're not alone. This is one of the biggest confusions in business finance. And today I'm going to break it down in a way that makes total sense. No jargon, just real talk. So let's start with a classic saying that you may have heard before. Turnover is vanity, profit is sanity, but cash flow is reality. So turnover is your total sales, all the total money coming in. Profit is what's left over after your costs of selling and your admin expenses. But cash flow is the real movement of cash coming in and out of your business. A report by 0-22 suggested that on average, businesses face cash flow challenges for over 4 months each year. So, okay, let's turn to the flip chart. So why does profit not always mean cash? Imagine you've had a great month, you've made a profit on paper, but why isn't there money in your bank? So let us take a look at the difference between cash and profit. So, VAT. VAT affects your cash balance, but not your profit. This isn't your money, but you're responsible for collecting it and paying it. Loan repayments. Again, loan repayments only impact cash. It doesn't impact your profit at all. However, the interest payments do. They affect both. And then imagine you're buying a bit of kit. Say it costs you £100. The initial price of this asset purchase obviously impacts your cash. But if it costs you £100 and say it's going to last you 5 years, the depreciation is what impacts profit. And we'd be taking that at £20 each year for the next 5 years. Next up is stock. Now, stock does impact profit for the amounts that you utilise and you've purchased during the period, whereas stock that you're actually holding at the year end or at the end of a month is actually, of course, only cash payments only. So from this you can see, so even if you've made a healthy profit, there may be no cash left over after making tax payments, loan repayments and asset purchases. Now we know the difference between profit and cash, let's talk about why money gets stuck in your business. So I want us to take a look at the cash conversion cycle of a service business. Let's take a marketing consultant. So we start the work when the client signs the proposal, perhaps on day one. We may work on this for about 25 days and we'll be spending money on salaries, contractors and perhaps other purchases. And then we complete the invoice on day 35, so another 10 days later. This means we've got work in progress for a whole 35 days. Now, we may have terms for invoicing our clients on 60 days payment terms, but actually they may take 75 days to pay. So that means we've got 75 days plus the 35 where we have work in progress. So that's a staggering 110 days where our cash is tied up. So if we think about this from a retail perspective, imagine you're buying clothes ready to resell in your shop. You make your stock purchase on day one, but perhaps you've got payment terms of around 35 days with your supplier. You may know, though, that you hold onto your stock for an average 65 days. So our cash is tied up in the business, 65, take your 35 that you've had from your supply term, which means we've got 30 days of cash tied up in your business. Now, if you're a wholesaler, you may extend this by the fact that you may have an extra, say, 30 days for your customers to pay you. So if this then takes a further 30 days, your cash is tied up for a total of 60. So I want to talk about a real-world example. So let's talk about a business that learned the hard way about the difference between profits and cash. Imagine a business that's had a couple of fantastic months. Sales are booming, profits are looking strong. And then when they looked at their bank account, there was £300,000 sitting there. They felt confident and decided to buy a new piece of equipment. They'd been after this for a while, and they paid for it outright of £150,000. Paying cash at the time seemed like a great idea. No finance costs, no debt. But here's what happened next. They also needed to pay VAT, and they took out a trunk for owner drawings. Plus, their business had such a long working cycle, which meant all the costs of expenses were going out first and money coming in from customers was taking a long while to get through. Before they knew it, there was a cash crunch. Bills were due, staff needed paying, and suddenly they had no buffer left in the bank. On paper, their business was still profitable. The profit and loss account looked healthy, but in reality, they were scrambling to make payments. They had to dip into their overdraft, negotiate with suppliers, and cut back on essential marketing. So what can we do about shortening this working capital cycle and keeping cash in our business? So let's look at things surrounding customers. We can shorten customer payment times. We can start requesting payments up front to help support with those initial ongoing costs. And make sure you're reviewing your terms and conditions and really consider, have you got your pricing right? Now, in terms of your purchases, start looking at your supplier's terms. Can you extend this payment date? Have you got the best deal available? And also stockpiling. Make sure you're not holding on to too much stock. See if you can move to more of a just-in-time basis. Now, in terms of other costs, have you got expensive borrowings? Are you taking a little bit too much out? And are there overheads that perhaps are creeping up that you hadn't even thought about? So one thing that catches a lot of businesses out is tax. Because let's be honest, when cash is tight, it's easy to spend the money without realising it's not actually yours. We're calling it the VAT trap. Every quarter, HMRC wants their share of your sale. If you've already spent the money, you're likely to be in a cash flow crisis. A great way to operate is to segment 20% straight away and put that VAT money in a different account. And also start planning for your corporation tax on a monthly basis. So if you're a 31st of December year end, let's have a think about when your taxes may be due. So you may be paying your PAYE on a monthly basis or quarterly. And let's assume that your VAT is in line with your year end. So this means you'll be paying your VAT on the 7th of February, 7th of May, and 7th of August. You'll then also pay corporation tax on the 1st of September, and then back into another VAT payment on the 7th of November, and this cycle will continue. So, 3 key tips to avoid these cash flow nightmares. The first one is to keep a cash flow buffer. Aim for at least 3 months' worth of expenses and reserves for that rainy day fund. Tip 2, forecast cash flow weekly. Use something like Xero or a simple spreadsheet to track your cash coming in and out over the next 90 days. Tip 3, invoice immediately. Set clear payment terms and use direct debits if possible. Remember, businesses don't fail because they aren't profitable. They fail because they run out of cash. Don't be one of them. Next episode, we look at how to stop cash flow anxiety for good, giving you some practical strategies to get control over your cash flow once and for all.